Hi Monish, good evening. Am I audible clearly? Hi Srijita. Yes, good evening. Today we will discuss NR taxation. At the same time, like on request of one student, I prepared some three problems also. That problems PDF I am sharing with you right now so that we will solve those problems. I have shared in my Telegram. These three problems. So we will. Shall we start? Non-resident taxation. I welcome you all for this most awaited lecture. See, determination of residential status, that and all I will discuss later. It is easy only. You also can learn. But from taxation of NRIs, non-resident Indians, and from taxation of non-resident, almost 7 to 8 marks are being asked in every examination. So first I will focus on taxation of NRIs, then I will discuss taxation of non-residents, then we will do some problems. NR taxation is very vast. So today I am trying to focus on taxation of NRIs as well as taxation of non-residents. Determination of residential status, business connection, taxation of interest, royalty fees for technical services, that I will plan in second part. Most probably again tomorrow also we will discuss non-resident taxation. In tomorrow session I will discuss those things. We will also do problems. Okay. Because non-resident taxation is such a chapter which I can't revise in 1.5. So first I will cover taxation of NRIs, and I will cover taxation of non-resident. Give me 1 second. Yes, we will start. Taxation of NRIs, non-resident Indians. First of all, who are called as NRIs? You have to tell Varun, Monish, Samir. Who are called as NRIs? Non-resident Indians. Taxation of NRIs, chapter 12A. This we are going to discuss right now. First of all, who are called as non-resident Indians? To call an individual as NRI, two conditions are required to be satisfied. First condition, he should be non-resident. Along with non-resident, he should be an Indian citizen or person of Indian origin. So whenever both these conditions are satisfied, then that individual we call as NRI. See, quite often you hear the word NRI. NRI means who? Any individual who is non-resident in India and who is an Indian citizen or who is a person of Indian origin. Then that person we call as non-resident Indian. Indian citizen who is not resident. Not only Indian citizen, if an individual is person of Indian origin and also non-resident, then that person also we can call as A. Are you able to understand? See, for non-resident Indians, certain benefits are given under income tax. Those benefits are given as per chapter 12A. Are you able to understand? What are those benefits? Let's say non-resident Indian is there. Non-resident Indian invested in foreign exchange asset. Where he invested? Foreign exchange asset. Sir, what do you mean by foreign exchange asset? I will tell you. So whenever non-resident make investment in foreign exchange asset, how investment should be made? Invested in foreign currency. That means he is purchasing foreign exchange asset not in Indian rupees. Non-resident Indian is purchasing foreign exchange asset using the foreign currency. Now, sir, what do you mean by forex asset? In shortcut, this is also called as forex asset. What do you mean by forex asset? Forex asset means shares of an Indian company. Indian company can be either private limited or public limited. Next, debentures or deposits with Indian public company. Debentures or deposits with Indian public. Very important. Only if it is a public company, then only it will be treated as forex asset. NRI purchased debentures issued by private limited company. If debentures are issued by private limited company, then those debentures are not forex asset in the hands of NRI. Debentures or deposit should be made in public limited company. Are you able to understand? Then only it will be treated as forex asset in the hands of NRI. Sir, what is the importance of forex asset? What is the significance? See, whenever forex asset is purchased by NRI, lower rate of tax will be levied. What is that lower rate of tax? I will tell you. Next, third investment is capital central government securities. So whenever non-resident Indian purchases forex asset means like shares of an Indian company, whether public limited or private limited, debentures or deposits of Indian public company, then only it is called as forex asset, capital gain security, sorry, central government security. Whenever these three assets are purchased, they will be called as forex asset. And whenever investment is made in forex asset, how that investment should be made? Investment should be made in foreign currency. Are you able to understand? Now, whenever this investment is made, from this income will be received by NRI. That income is not taxable at general rates. That income is taxable at concessional tax rates, lower tax rates. Sir, what is the lower tax rate? Whatever the income is there, if income is investment income, such investment income is taxable at the rate of 20%. Sir, what do you mean by investment income? NRI is purchasing shares of Indian company. From shares of Indian company, dividend can be received. Dividend is investment income. He is purchasing debentures of Indian public company. From debentures, interest will be received. Interest is also considered as investment income. On investment income, tax rate applicable is 20%. The thing is, this 20% is gross, taxable on gross basis. No expenditure is allowed as deduction. No chapter 6 reductions are allowed. Whatever investment income is there, on investment, total investment income without any deduction, you are going to apply 20% tax rate. Are you able to understand? Uh, if the nature of income is long-term capital gain, then tax rate applicable is 10% if long-term capital gain is before 23rd July. If long-term capital gain is on or after 23rd July, then tax rate applicable is 12.5. My dear students, you need not check whether forex asset is taxable under section 112A or 112. That is different. Okay, for NRA separate taxation is there now. So from this, on sale of forex asset, whatever the capital gain that is received, whether it is taxable under 112A or 112, that is not necessary. On sale of forex asset, whatever the long term capital gain is there, on that long term capital gain, tax rate applicable is 10% or 12.5%. Are you able to understand? If there is any other income, then other income is taxable at normal tax rate. Other income taxable at, non-resident tax rates, right? Even non-resident individual also, he has two options. Either he can pay taxes under default tax rates or optional tax rates. So like other income is taxable at slab rates. Are you able to understand? Now, whatever investment income is there, investment income, that is dividend or interest. Investment income is taxable on gross basis. No deduction will be allowed. Expenditure not allowed as deduction. Chapter 6 reductions also not allowed as deduction from investment income. Investment income is taxable on gross basis. Next, non-resident Indian sold forex asset. On sale of forex asset, there will be capital gain. Let's say there is long-term capital gain. Then that long-term capital gain is taxable at 10% or 12.5%. While calculation of this long-term capital gain, indexation benefit is not available. Even before 23rd July 2024, indexation benefit is not available while calculating capital gains on transfer of forex asset. Okay, next. Chapter 6A deductions are also not allowed while calculating. So whatever the long term capital gain is there, from such long term capital gain you cannot claim chapter 6A deductions also. But there is first proviso to section 48. First proviso to section 48. See, whenever non-resident purchased shares of Indian company, then we have discussed full value of consideration is to be calculated in dollars. Transfer expense also to be calculated in foreign currency. Capital gain also calculated in foreign currency. Whatever the capital gain in foreign currency is there, that will be converted into Indian rupees. And while converting Indian rupees into foreign currency for the purpose of calculation of, for full value of consideration transfer expense, we will consider average of buying and selling rate as on the date of transfer. For conversion of cost of acquisition, we will consider average rate as on the date of purchase. Okay, so normally in case of non-resident, whenever he purchase shares or debentures of Indian company, then what will we do? We will calculate capital gains in foreign currency. Whatever the capital gain in foreign currency is there, that we will convert to Indian currency. That's what we have studied in first proviso to section 48. That first proviso to section 48 is also applicable for non-resident Indian. Are you able to understand? See, non-resident is different, non-resident Indian is different. Directly, he is not Indian citizen, he is foreign citizen. He came to India, he is non-resident in India. Directly can never be NRA. Directly can only be NR, because Directly is not an Indian citizen. Directly is not a person of Indian origin. So Directly in India we call as non-resident. Are you able to understand? Like whatever this first proviso to section 48 is there, that is applicable for non-resident as well as for NRI also. For non-resident Indian also, first proviso to section 48 is. Are you able to understand? So till here, are you clear? Everybody, please comment. Hi Niranjan, finally your wish came true. Okay, you are asking NR taxation from lot of time. Next. See, foreign exchange asset is there. Foreign exchange asset transferred. On transfer of foreign exchange asset, there is long-term capital gain. Now, from this long-term capital gain, you can claim exemption. Are you able to understand? So, whatever long-term capital gain is there, if long-term capital gain is reinvested within 6 months. Reinvested within 6 months from date of transfer. Then whatever the amount reinvested is not eligible for exemption. Proportionate exemption is to be calculated. Are you able to understand? So whatever the long term capital gain is there, if it is reinvested. Interest income, which section? Interest income, like we are discussing section 115. Reinvested within 6 months from date of transfer. Where reinvestment should be made? Reinvestment should be made in any other foreign exchange asset or reinvestment should be made in savings certificates issued under section 10(4)(b). So if reinvestment is made in another foreign exchange asset or if reinvestment is made in saving certificates issued under section 10(4)(b), whatever the amount reinvested, total amount reinvested is not eligible for exemption. Proportionate exemption is to be calculated. How to calculate? Exemption is equal to long term capital gain into amount reinvested divided by net consideration. Okay, so proportionate exemption is allowed as deduction. So what is time limit for reinvestment? Time limit for reinvestment is 6 months. Let's say there is one guy, Sundar Pichai. He is non-resident in India, but he is Indian citizen. Sundar Pichai is NRI. Sundar Pichai is having shares of Reliance Limited. Now Sundar Pichai sold shares of Reliance Limited. Now Sundar Pichai will get long-term capital gain. Now whatever the long-term capital gain that is received, if it is invested in shares of another Indian company or if it is invested in saving certificates issued under section 10(4)(b). Are you able to understand? Then whatever the long-term capital gain that is reinvested, total reinvestment is not eligible for exemption. Proportionate exemption will be allowed. Long-term capital gain into amount reinvested divided by net consideration. Next, lock-in period. You know lock-in period, right? Whatever the new asset that is purchased is there. See, Sundar Pichai sold shares of Reliance Limited. He got long-term capital gain. Long-term capital gain is reinvested in shares of Wipro Limited. Now, whatever new foreign exchange asset that is purchased, whatever shares of Wipro Limited that are purchased are there, they are not to be transferred within 3 years from the date of purchase. That means from date of reinvestment for next 3 years, you should not transfer the new foreign exchange asset. Are you able to understand? Sir, what if he transfers Wipro shares within 3 years from date of purchase in case of violation? Violation means what? Transferred within 3 years from date of purchase. Violation means transferred within 3 years from date of purchase. Then earlier exemption claimed. Earlier exemption is taxable as long-term capital gain in year of violation. Are you able to understand? So in the year he violates, in that year, whatever the earlier benefit that was taken, earlier benefit is taxed as. Till here, did you understand, everybody? Section 115C. What section 115? Not 115C, section 115. What section 115H says? Let's say in 2023-24, he is NRI. But in 24-25, he became resident in India. Now the question is, sir, if he is NRI, these benefits are available. Okay, if he is NRI, all these benefits are available. Investment income is taxable only at 20%. Long-term capital gain taxable at 10% or 12.5%. Now, in the year in which he purchased a foreign exchange asset, in 23-24 he purchased Reliance Limited shares. In 23-24 he is NRI, but in 24-25 he became resident in India. Now, what is the situation, sir? Earlier he is NRI, but in current previous year he is resident in India. Even though he is resident in India, still NRI provisions will continue to apply. Provisions will continue to apply if declaration is given by SEP. Are you able to understand? If declaration given by, that means what? Sundar Pichai has to give declaration in 23-24 I am NRI. As an NRI, I purchased foreign exchange asset, but in 24-25 I become resident in India. So even though I become resident in India, I will opt the provisions. I wish to continue the same NRI provisions. So if he gives declaration while filing ITR, that option is available whether you wish to continue to apply NRI provisions. If that option is selected, then even though he is resident in India, still those NRI provisions will continue to apply, and still whatever that investment income is there, that is taxable at the rate of 20%. Are you able to understand? Still investment income is taxable at the rate of 20%. Students, today's class is very important. Taxation of NRI, taxation of non-resident, easily 6 to 8 marks are being asked in the examination. Nowadays he is not focusing that much on foreign fees for technical services. That introductory part, whatever determination residential status is there, that he is not testing. He is testing taxation of NRI and tax. Next, one last point is there, section 115I. What section 115I says? Whatever chapter 12A provisions are there, whatever chapter 12A provisions are there, these chapter 12A provisions are optional. Provisions are. What do you mean by this? NRI have two options. If NRI wants normal tax rates, he can choose normal tax rates. Or if NRI wants chapter 12A, he can choose chapter 12A. So whatever chapter 12A provisions are specifically drafted for non-resident Indian are there, those are not mandatorily applicable for non-resident Indian. It is up to the choice of the NRI. If NRI wants to choose these provisions, he will choose these provisions. Otherwise, he will pay taxes at normal tax rate. Are you able to understand? Let's say investment income 4 lakhs was received. Now 4 lakhs is taxable at the rate of 20%. And I will advise NRI not to choose chapter 12A, because if you choose regular provisions up to 2,50,000 basic exemption and only balance 1 lakh is taxable, that too at the rate of 5%. So I will advise to choose normal tax rate. So whatever these NRI provisions are there, they are not mandatory on NRI. If he wants to follow, he will follow. Otherwise, he can pay taxes at normal. You will understand. Whenever NRI is having investment income, then ITR is not required to be filed. Are you able to understand? So NRI not required to file ITR if two conditions are satisfied. If total income includes investment income and capital gain, long-term capital gain, and TDS is deducted. If these two conditions are satisfied, that means NRI total income consists of only two incomes: investment income, long-term capital gain, and TDS is already deducted. If these two conditions are satisfied, NRI is not well. Now open the problem, we will solve the problem. All of you, are you having problems with you? I have shared this PDF in the Telegram group. I hope you understood the concept taxation of NRI. Now we will solve one problem also. You will get clarity. Open question 1. I'm sorry, in just 10 minutes, I picked these problems, and these are also done by me editing. So that's why editing was not proper. I have no time to give this work to my editor. The following data is furnished by Mr. Rahul, a non-resident and a person of Indian origin. Careful while reading the question. He is non-resident and also a person of Indian origin. So can we tell Rahul as NRI? Both the conditions are satisfied. Na? Rahul is non-resident. He is person of Indian origin. As both the conditions are satisfied, we can tell Rahul as NRI, non-resident Indian. For financial year ended 31st March 2025, long-term capital gains arising on transfer of foreign exchange asset on 21st July. See, when foreign exchange asset was transferred 21st July, that means before 23rd July or after 23rd July. Before 23rd July, na. If it is before 23rd July, while calculating long-term capital gains, what is the tax rate? 10% or 12.5%? 10% tax rate is applicable. Next, expenditure incurred wholly and exclusively incurred in connection with such a transfer. Nothing but transfer expenses. We will reduce transfer expenses. Interest on deposits held with private limited companies. Super point. See, if you purchase debentures with private limited company, is it a foreign exchange asset? This is not a foreign exchange asset. Okay. Only if debentures or deposits are made in public company, then only it will be treated as foreign exchange asset. Are you able to understand? Now, interest on government securities. The interest on government securities is a foreign exchange asset. What I said? Shares of Indian company, debentures or deposits of Indian public company, central government securities. So central government securities will be treated as foreign exchange asset. Next, interest on deposits with public limited companies. So whatever the deposit, see where investment is made in deposits of public limited company. So it is a foreign exchange asset. Are you able to understand? From foreign exchange asset, if any investment income is received, that is taxable on gross basis at the rate of 20%. Next, savings and investments. Investment in notified savings certificates in section 104B on 30 March 2025. See, reinvestment should be made within how much period? Reinvestment should be made in 6 months. Na? When these are transferred on 21st July 2024. So date of transfer 21st July 2024. 6 months means 20 August 2024, 20 September 2024, 20 October 24, 20 November 2024, 20 December 2024, 20 January 2025. So 20 January 2025, that is 6 months. But when reinvestment was made on 30th March. Reinvestment made on 30th March 2025. So whether reinvestment was made within 6 months or after 6 months. Reinvestment was made after 6 months. As reinvestment was made after 6 months, exemption is not available. See, whatever reinvestment 2 lakhs is there, that is not eligible for exemption because reinvestment was made after 6 months from date of transfer. Time limit for reinvestment is only 6 months. Okay. Investment in shares of Indian Public Limited Company as on 31st December 25. See, 30th March 2025 is only after 6 months. 31st December 2025 means this is also obviously after 6 months. Na? So if reinvestment is made after 6 months, that reinvestment is not eligible for exemption. Are you able to understand? Compute balance tax payable or refund due for assessment year 25-26 in accordance with special provisions applicable. See, in question clearly specified in accordance with special provisions applicable to non-residents. That means in question he himself is asking us to calculate tax liability using special provisions applicable to NRIs. Next, assume SSC opted out of 115 BSE means he is opting out of default tax rates and he is paying taxes under optional tax rates. Are you able to understand? So shall we calculate the income, everybody? Now, before we calculate, one important point. Long-term capital gain that is taxable at the rate of 10% because transfer was made before 23rd July 24. This is not a foreign exchange asset, na? So this is taxable at normal tax rate. Interest on government securities, interest on deposits with public limited company. These two are foreign exchange asset. As their foreign exchange asset, investment income is received. So it is taxable at 20%. Are you able to understand? So first we are clear with tax rates. Investment income 20%, long-term capital gain 10%, other income taxable at normal rates. So first we will calculate investment income. How much is investment income? Calculation of total income. Investment income. Now, investment income, two incomes are there na, interest on government securities, interest on government securities, interest on deposit with public company. Am I correct? Deposit with public company. How much? 95,000, 2,60,000. Whatever this 95,000, 2,60,000 is there, this is investment income and this is taxable at the rate of 20%. Are you able to understand? Long-term capital gain. How much is full value of consideration? Full value of consideration is 6,50,000. How much are transfer expenses? Transfer expenses are 80,000. How much is net consideration? 6,50,000 minus 80,000. 5,70,000. Now, whether indexed cost of acquisition is available? No, I said indexation benefit not available. From this long-term capital gain, you cannot claim Chapter 6 deductions. Another important point, yeah, 5,70,000. How much is cost? Hmm, cost. So it is already computed. Computed means what? After claiming cost of acquisition. Okay. So whatever long-term capital gain is there, that is already computed. So this is not full value of consideration. This is long-term capital gain only. So long-term capital gain 6,50,000. Transfer expenses 80,000. So after deduction of transfer expenses, long-term capital gain is 5,70,000. From this, can we claim exemption? Exemption is not available. Why exemption is not available? Because reinvestment was made after 6 months. Are you able to understand? So, taxable long-term capital gain is 5,70,000 rupees. On long-term capital gain, applicable tax rate is 10%. Now, how much is other income? See, deposits with private limited company, that is not foreign exchange asset na. So other income is 5,90,000 rupees. Interest on deposit with private limited company. Private limited. How much? 5,90,000. So how much is the total income? Calculate 5,90,000 plus 5,70,000 plus 95,000 plus 2,60,000. 15,50,000. Am I correct? Let's check. Next, shall we calculate the tax liability? Calculation of tax liability. Tax liability of Rahul. We already discussed investment income is taxable at the rate of 20%. So, tax on investment income. How much is investment income? 95,000 plus 2,60,000. 3,55,000. 3,55,000 to 20%. 71,000. Long-term capital gain is taxable at the rate of 10%. So, tax on long-term capital gain. How much? 5,70,000 na? 5,70,000 into which is 57. Next, how much is other income? Other income is 5,90,000. Up to 2.5 lakh nil. Greater than 2.5 lakh up to 5 lakh. Tax rate is 5%. Tax amount is 12,000 because he is paying taxes under optional tax. Above 5 lakh up to 10 lakh tax. So 90,000 into 20%, 18,000. So total is 30,500. How much? 30,500 plus 57,000 plus 71,000. 1,58,000. To this we need to add 6,000. So how much is fine? 1,64,000. Yeah, 1,64,840. TDS deducted is 1,83,000. So refund is 8. So everybody, are you clear with question 1? Then we will quickly do question 3 as well. Question 3 I will not write everything, but I will explain with the answer because we are lacking. Next, Arohi, a non-resident Indian, has the following sources of income in India during previous year 24-25. Income from house property located in India. Computed means what? After claiming standard deduction after claiming interest on borrowed capital, whatever the income from house property is there, ultimate income from house property was given, it is 1,80,000. See, again she is non-resident Indian, that means she is NRI. Income from house property is other income na, so obviously it is taxable at normal tax rates. Dividend from Indian companies. See, this is foreign exchange asset, not dividend from Indian companies. So obviously it is investment income. On investment income, tax rate applicable is 20%. Next, interest on debentures of Indian company subscribed in convertible foreign exchange. See, I told you, foreign exchange asset means investment should be made in foreign currency and debenture should be purchased of Indian public company. Here, Indian company was given. If no clarity was given, let us take assumption it is public company only. I told you, investment income for foreign exchange asset is taxable on gross basis. Income is 1 lakh, expenditure is 20,000, net income is 80,000. Tax is not applicable on 80,000, tax is applicable on gross basis 1 lakh rupees. Are you able to understand? Long-term capital gain on sale of debentures subscribed in US dollars. Sale value 6 lakhs, cost is 4 lakhs, transfer expenses 6,000. Okay. So ultimate long-term capital gain is 1,94,000. Now, whatever the long-term capital gain is there, what is the date of transfer? 10th December 24. That means after 23rd July na. So as it is after 23rd July 2024, tax rate applicable is 12.5%. Are you able to understand? So you already know on long-term capital gain, you will apply 12.5%. Next, whatever the interest income is there, 1 lakh, you can see it is taxable on gross basis. So investment income on foreign exchange, again foreign exchange asset, against that investment income, expenditure is not allowed as deduction. Chapter 6 reductions are not allowed. It is taxable on gross basis. So you can see income from house property 1,80,000. This is other income na. Other income is taxable at normal rates. So you can take the benefit of basic exemption limit. Basic exemption limit available is 2,50,000. Other income you can set off against basic exemption limit. Balance income, it is taxable at uh, special tax rates applicable for NRI. Investment income taxable at 20%. Long term capital gain taxable at the rate of 12.5%. Okay. Next, shall we discuss other concepts? This is all about taxation of NRI. In one case scenario question, I think in November 2024, he asked 8 marks exclusively relating to taxation of NRI. Okay, because this concept is only at final level now, definitely he will test this. Next, we will discuss special tax rates for NR. Special tax rates for non-resident. Till now, we discussed about tax treatment of non-resident Indian. Now we are going to discuss about tax rate of non-resident. Shall we discuss everybody? See, India always needs money because India is not a developed country. India is a developing country. So foreigners have more money. So how to attract foreigners to make investment in India? To give concession in tax rates. So for non-residents, tax like concession will be given in tax rates. At the same time, Let's say in foreign, if you go to foreign, the rate of interest is very low. Interest rate is 2%, 3% like that, because inflation is low. In India, inflation is very high, therefore interest rate is very high. In India, interest rate will range from 9% to 12%. So how can we attract foreigners? Like we will issue securities to foreigners, or we will issue uh, debt securities to foreigners. We will issue rate of interest high. We will offer 8% interest rate. In foreign, non-residents will not get 8% interest rate. Obviously, they will show interest in investing in India because they will get 8% interest. Are you able to understand? At the same time, that is one offer. Another offer is whenever they make investment in India, lower tax rates will be levied. So that will encourage more non-residents to come into India and make investment in India. So to encourage more investments from non-residents, special tax rates are applicable for non-residents. What are those special tax rates that we will see now? Okay. This is chapter 12. See, NRI chapter 12A, NR non-resident chapter 12. Okay. There is non-resident or foreign company. Non-resident or foreign company made investment in infrastructure debt fund, infra debt fund. Sir, what do you mean by infrastructure debt fund? Infrastructure debt fund is a debt fund that is incorporated in India that will take money from non-residents, and that money will be given as loans to NRIs in India. Sorry, that will be given as loans to those companies who are involved in infrastructure business. Are you able to understand? So let's say Sundar Pichai is NRI. He made 1 crore rupees investment in infrastructure debt fund. What infrastructure debt fund will do? This 1 crore rupees will be given as loan to various infrastructure companies. Are you able to understand? Now, on this investment, see, non-resident or foreign company is making investment in infrastructure debt fund. From this investment, they are going to get the income. Now, that income is taxable at normal rates. What is the income that they will get? They will get interest income. Whatever the interest income that is received, that interest income is taxable at normal rates. Sir, what is the tax rate? That interest income is taxable at the rate of 5% plus applicable surcharge plus 4% HEC. Are you able to understand? So, see, non-resident in India slab rates up to 2,50,000 nil, greater than 2,50,000 up to 5 lakh 5%. Above 5 lakh tax rate applicable is 20%. But normal slab rates are not applicable whenever investment is made by non-resident in infrastructure debt fund. Whatever the interest income that is received, that is taxable at a very low tax rate of 5% plus applicable surcharge plus health and education cess. And see, we cannot catch non-resident. Na, Malia went to London. It's been more than 6 to 7 years. Indian government could not catch Malia and could not bring Malia into India. That's why before making any payment to non-resident, TDS is required to be deducted. So whenever any interest is paid on infrastructure debt fund to non-resident or foreign company, on such interest, TDS is required to be deducted. Okay. So infrastructure debt fund will deduct TDS. Under which section? It will deduct TDS under section 194 LB. Sir, what is the rate of TDS? TDS will be deducted at the rate of 5% plus applicable surcharge plus health and education. If you remember, in TDS chapter I have told you, TDS provisions relating to NR will be discussed here. Okay. See, now infrastructure debt fund earns income in India, na? whatever the income earned by infrastructure debt fund is there, such income is not at all taxable. Such income is exempt under section 10(4)(b), 1047. Are you able to understand? Income earned by infrastructure debt fund in India, total such income is exempt. I hope you are clear with section 115A. This is section 115A, whatever that we have discussed. Investment in infrastructure debt fund by non-resident or foreign company. Are you clear, everybody? Did you understand section 115A? I can't do anything. NR taxation is like this. We should keep on discussing different sections with different tax. Shall I explain further? Are you there? Anyone? Next, same 60, section 115A, non-resident or foreign company is there. Now, what non-resident or foreign company has done? They have given foreign currency loan. They gave foreign currency loan to Indian company or business trust. We have discussed business trust concept in earlier lecture. So, non-resident or foreign company, they have given foreign currency loan to Indian company or business trust. And this loan agreement, whatever this loan is there, this agreement was entered in between 1st July 2012 to 30th June 2023. So, if any foreign currency loan is given by non-resident or foreign company, either to Indian company or business trust, subject to the condition, such foreign currency loan agreement should be entered on or after 1st July 2012, but before 30th June 2023. As per that loan agreement, if any interest is paid, okay, then that interest income is taxable to non-resident at a concessional rate. Okay, that interest income is taxable to non-resident or foreign company at a concessional rate of 5% plus applicable surcharge plus health and education. Are you clear? So, non-resident infrastructure debt fund interest income 5%. Non-resident foreign currency loan given in between 1st July 2012, 30th June 2023. Interest income received taxable at lower tax rate of 5%. Are you clear till here? Non-resident or foreign company. There is Indian company or business trust. Now, non-resident or foreign company subscribed long-term bonds. Long-term bonds issued till 30th June 2023. Till 30th June. Or non-resident or foreign company, they have purchased rupee denominated bonds issued till 30th June 2020. Issued till 30th June 2020. So, non-resident or foreign company, infrastructure debt fund, interest income received 5%. Case 2, non-resident or foreign company giving foreign currency loan. Then also whatever interest income received taxable at the rate of 5%. Non-resident or foreign company has invested, okay, has subscribed long-term bonds issued by Indian company or business trust, or non-resident or foreign company purchased rupee denominated bonds issued by Indian company or business trust. Then on all these, interest income will be paid na. Whatever the interest income that is paid is there, this interest income is taxable at the rate of 5%. Are you able to understand? 5% plus applicable surcharge plus health and education cess. Now, TDS is required to be deducted. Sir, under which section TDS will be deducted? TDS will be deducted under section 194 LC. So, whatever this interest income is there, before this interest income is paid to non-resident or foreign company, TDS is required to be deducted under section 194 LC at the rate of 5% plus applicable surcharge plus health and education cess. Is it clear? So we can tell one conclusion: whatever interest income that is received, it is taxable at 5%. TDS will also be deducted at 5%. Are you clear? Now, whatever these rupee denominated bonds are there, if rupee denominated bonds are issued in between 17 September 2018 and 31st March 2019. So, if non-resident or foreign company purchases rupee denominated bonds issued in between this period, what is the period? 17 September 2018 to 31st March 2019. Okay, because 2019 is election year, benefit was given. What is the benefit? If any rupee denominated bond is purchased during this tenure, then on those rupee denominated bonds, whatever the interest income that is received is there, whatever interest income is there, that interest income is fully exempt lifetime. Okay, that interest income is never taxable, that interest income is fully exempt lifetime. Okay, whatever these long term bonds issued till 30th June 2023 and whatever rupee denominated bonds issued up to 30th June 2023 are there, if these two, if these two are issued on or after, if they are issued on or after 1st April 2020 but before 30th June 2023, before 30th June 2023, and these are purchased, see, non-resident or foreign company, they are purchasing denominated bonds. When they are purchasing rupee denominated bonds, they are purchasing in between 1st April 2020 and 30th June 2023. They are purchased from recognized stock exchange located in IFSC. Are you able to understand? So if any rupee denominated bonds are purchased from recognized stock exchange located in IFSC in between 1st April 2020 and 30th June 2023. Then on those rupee denominated bonds, interest income will be paid na. On that interest income, tax rate applicable is only 4%. Are you able to understand? Generally, tax rate is 5% for interest income. But if rupee denominated bonds are purchased from recognized stock exchange located in IFSC, tax rate applicable is not 5%, tax rate applicable is only 4%. But if they are purchased after 30th June 2023, then tax rate applicable is 9%. Are you able to understand? Tax rate 9% is applicable. Niranjan, are you able to understand? You have waited for this lecture for so long time. Very simple. Generally on rupee denominated bonds, if any interest income is received, taxable at 5% only. But if rupee denominated bonds are purchased from recognized stock exchange located in IFSC before 30th June 2023, then 5% not, even lesser, 4% tax rate is applicable. Are you able to understand? But if rupee denominated bonds are purchased from recognized stock exchange located in IFSC on or after 30th, like after 30th June 2023, then tax rate applicable is 9%. Shall I explain further? Next, non-resident foreign company, they have invested in business trust. This point we already studied in business trust concept. So whenever non-resident or foreign company invest in business trust, from business trust, dividend income will be transferred now. So whatever dividend received from SPV, that will be passed on to non-resident or foreign company. Whatever the dividend income passed on to non-resident or foreign company is there, that is taxable now. What is the tax rate that is taxable? Taxable to non-resident or foreign company at the rate of 10% plus applicable surcharge plus health and education cess. So see, we discussed 2 points. Special purpose vehicle, it is paying taxes as per normal tax rates 25%, 30%. Then whatever dividend income received by non-resident, not at all taxable, fully exempt. But whatever special purpose vehicle is there, it is not paying taxes at 25% or 30%. It is paying tax at concessional tax rates under section 115 BAA. In that case, whatever the dividend income received, that is taxable to non-resident or foreign company, the tax rate applicable on dividend income is 10%. But on this dividend income, whatever the dividend income is there, from this dividend income, TDS will be deducted under section 194 LBA at the rate of 10% plus applicable surcharge plus health and education. Are you able to understand? This already we have discussed. Next, general provision. Non-resident or foreign company, if it gives any foreign currency loan, to Indian company or Indian government, then on that interest income will be received na, that interest income is taxable at the rate of 20%. Whatever that interest income is there, that is taxable at the rate of, that is general. So normally if interest income is received by non-resident or foreign company, tax rate applicable is 20%. That is the maximum tax rate applicable on interest income. Next, non-resident or foreign company, if they receive any dividend, if they receive dividend or income from units of UTI, if they receive any dividend or income from units of UTI, whatever the dividend income that is received is there, the dividend income is taxable at the rate of 20%. But if dividend is received from IFSC, very very important, dividend received from IFSC, then tax rate applicable is only 10%. Are you able to understand? Non-resident foreign company getting dividend from dividend income or any other income from units of UTI, tax rate 20%. But if dividend income is received from units purchased in IFSC, International Financial Service Center, then on those units, whatever the dividend income that is received, on such dividend income, tax rate applicable is only 10%. Are you able to understand? Shall we discuss further? Till here, are you clear? Very simple. Interest on securities, infrastructure debt fund, or foreign currency loan, whatever the interest income is there, that is taxable at 5%. Next, dividend income taxable at 10%. Normal interest income, any other interest income received by non-resident or foreign company, either from Indian government or Indian concern, taxable at 20%. Next, if dividend is received from units of UTI, tax rate applicable is 20%. But if units are purchased from IFSC, then tax rate applicable is only 10. Actually, I'm having class these days till 6 o'clock. So from class to home, I could not reach by 7 p.m. That's why I extended class time from 7 to 7. Next, section 115 AB. See, nowadays, non-resident or foreign company, they can directly invest in Indian share market or they can directly purchase Indian shares. Once upon a time, non-resident or foreign company, they cannot directly purchase shares in Indian stock market. They can only purchase through mutual fund. So non-resident will invest money in mutual fund. Mutual fund will invest money in Indian shares or Indian stock market. Now, 115 AB, Overseas Financial Organization. It is also called as OFO. Let us keep the shortcut OFO. Overseas Financial Organization is there. It made investment. It made investment in mutual fund or UTI. Whatever the investment that is made, investment was made in foreign currency. Now, from this investment, they are going to receive the income. Now, income is of two types: revenue income, capital income. Revenue income is now that income is like normal income. It is taxable at the rate of 10%. Revenue income. If it is capital income, long term capital gain, that long term capital gain is taxable at the rate of 10% or 12.5%. Are you able to understand? So overseas financial organization, it made investment in mutual funds or units of UTI. From that investment, income was received. That income, if it is revenue income, taxable at the rate of 10%. If it is capital gain, taxable at the rate of 10% before 23rd July. After 23rd July, taxable at the rate of 12.5%. Now, your doubt is, sir, what overseas financial organization means? Okay, so overseas financial organization means an institution or an association or a body established under foreign law. So we can simply tell any entity incorporated outside India established under foreign law. Now this entity entered into agreement. It entered into agreement for investment in India. For investment in India, with whom it entered into agreement for investment in India, either with public financial institution or public sector bank PSB or with any mutual fund. Whatever this agreement is there na, this agreement should be approved by SEBI. should be approved by SEBI. Then we call it as investment made by overseas financial organization in units of UTI or other mutual. Okay. Honestly, NR taxation requires next level preparation and probably the only complex chapter in DT, as we have to remember a lot. Very simple logic, Monish. Now you are listening this revision lecture. Na first time you are listening. Next time when you are listening, listen in 1.5. Like listen it 3 to 4 times. When you listen it for 3 to 4 times, it will automatically register in your subconscious mind. Definitely you will remember. Not a problem at all. Any complex concept you take, the only thing that matters is revision. If you revise it for n number of times, it becomes so easy for you. Okay, so don't be afraid of non-resident taxation. Face non-resident taxation, listen it multiple times, keep your efforts, automatically you will remember. So overseas financial organization means any entity incorporated outside India. So any entity established under foreign law, if it enters into agreement for investment in India, either with public sector bank or public financial institution or mutual fund. Okay, and that agreement should be approved by SEBI. Okay, then that organization we call as overseas financial organization. So this is all about section 115 AB. Next, I will discuss section 115 AC. Shall I discuss 115 AC? Section 115 AC. I strongly feel whatever the concepts that I am discussing today, from these concepts only you will get question. Because how to determine residential status, that and all inter-level concept. In inter only he is asking questions. At final level, he is not testing how to determine residential status. He is also not testing business connection that much. Most of the time he is testing about taxation of NRIs and taxation of non-residents. So these today's lecture is very important. Niranjan, are you following this lecture today? Very, very important. Section 115 AC. Non-resident or foreign company, they invested in GDRs, Global Depository Receipts, or foreign currency convertible bonds of an Indian company. You know GDRs, right? In CA Inter Financial Management, GDRs is theory question. 4 marks theory question. You would have studied like difference between GDR and ADR, Global Depository Receipts and American Depository Receipts. That theory question will be there. Okay. So very simple. Now Indian company is there. Adani Limited is there. Adani Limited wants to issue shares in USA. Whether Adani Limited can issue shares in USA, whether Adani Limited can issue shares in NASDAQ, can it list shares in NASDAQ? Not possible. Now, so what Adani Limited will do? There is one bank called S Bank in USA. Adani Limited will issue shares to S Bank. S Bank, keeping those shares as underlying asset, S Bank will issue global depository receipts to non-residents. Now, non-residents will give money to S Bank. S Bank will give money to Adani Limited. Are you able to understand? So, global depository receipts are a medium for getting foreign money. So, if, like you cannot issue shares outside India. So, you will issue shares to a bank located outside India. That bank keeps those your shares, your company shares as underlying asset, and it will issue GDRs, Global Depository Receipts. Non-residents will purchase the GDRs, amount will flow to foreign bank will make investment in India. Are you able to understand? So, if any GDRs are issued or if any investment is made in foreign currency convertible bonds of Indian company, on this income will be received by non-resident or foreign company. Now, on this income, if the nature of income is interest or dividend income, then that interest or dividend income is taxable at the rate of 10%. If it is long-term capital gain, then it is taxable at the rate of 10% or 12.5%. In this case, while paying this income, TDS is required to be deducted under section 196C. Sir, what is rate of TDS? For normal income, rate of TDS is 10% plus applicable surcharge plus HEC. For capital gain, rate of TDS is 10% or 12.5% plus applicable surcharge plus HEC. That is TDS rate under section 196. Today, NR taxation viewership is very low, very low. But what can I do? N number of times I can only revise these tax rates. So did you understand 115 AC? Next I will explain section 115 AD. Shall I explain? Section 115 AD speaks taxation of foreign institutional investors. For foreign institutional investors also special tax rates are there. What are those special tax rates that we will see right now? Now, foreign institutional investor, he received any income from India. He received any income on security in India. Any income on security, very important, other than interest on units of UTI or mutual fund. Sir, why other than interest on units of UTI or mutual fund? Because they are already covered under 115 AB. Under 115 AB, we have already discussed. So, foreign institutional investor, if he gets interest income on units of UTI or mutual fund, whatever the income that is received, that is taxed as per section 115 AB. Other than income from UTI or mutual fund, if any other income is received, for such other income, section 115 AD gets attracted. Are you able to understand? Sir, what is the tax rate? Whatever the income that is received, if that income is long-term capital gain, if that income is long-term capital gain under section 112, tax rate applicable is 10%. See, generally amendment was made before 23rd July, long-term capital gain under section 112, tax rate applicable is 20%. On or after 23rd July 2024, tax rate applicable was reduced from 20% to 12.5%. But in this section, lawmakers, I think it is drafting error. Lawmakers did not write the tax rate at 12.5%. So like whenever long-term capital gain under section 112 is received by foreign institutional investor, whether before 23rd July or after 23rd July, tax rate applicable is only 10%, 12.5% is not applicable. Generally, see, for every long-term capital gain on or after 23rd July, tax rate applicable is 12.5%. But when you read section 115 AD, you will not find 12.5% for long-term capital gain under section 112. Probably the lawmakers, they forgot to make the amendment. They might make amendment in upcoming finance acts. But the thing is, everywhere you see long-term capital gain under section 112 taxable at the rate of 12.5% after 23rd July 2024. But in case of foreign institutional investor, long-term capital gain under section 112 is still taxable at the rate of 10% only, whether before 23rd July or after 23rd July 2024. Okay. If the nature of income is long-term capital gain under section 112A, then up to 1.25 lakh exempt. Greater than 1.25 lakh, it is taxable. What is the tax rate? Tax rate is 10% before 23rd July. Tax rate is 12.5% on or after 23rd July 2020. Okay. If it is short-term capital gain under section 111A, tax rate applicable is 15% or 20%. Before 23rd July, tax rate 15%. On or after 23rd July, tax rate applicable is 20%. Next, short-term capital gain. Other short-term capital gain, tax rate applicable is 30%. If there is any income, investment income, that means dividend income or interest, then the dividend or interest that is taxable at the rate of 20%. Another important thing is, for all these incomes, whatever the incomes that we have discussed it under section 115 AD, for all these incomes, maximum surcharge rate applicable is only 15%. Generally, if total income is more than 2 crores, higher surcharge rate, 25%, 37% gets attracted. But in case of foreign institutional investor, whatever the income received under section 115 AD is there, on such income, maximum surcharge rate applicable is only 15%. Okay. So that's all for today. This is all about taxation of NRIs and taxation of non-resident. Remaining provisions, how to determine residential status, that is simple only, that we will discuss tomorrow. Tomorrow also at the rate 7:30 p.m. we will have this. Okay, thank you very much. Bye. Good night.